Hey there, it's Chris Goff, and in this training video, I want to cover the basics of a wraparound mortgage, what it is, how it works, and when you would use one. So today I queried all absentee owners in the entire US where the property value was above $300,000 with at least 20% equity, and they've owned the home for at least 2 years. And that number is 7,284,401. Now, this is mostly single-family residential properties because this is the ideal marketplace to do this. Now, for those of you getting started, when we talk about wraps, we're actually talking about seller financing where the owner is willing to basically become the bank. This is great when you don't want to apply for a normal bank loan or have it on your credit report. So let's jump in and learn all about wraps. So what is a wraparound mortgage? A wraparound mortgage, more commonly known as a wrap, is a form of secondary financing for the purchase of real property. The seller extends to the buyer a junior mortgage, which wraps around and exists in addition to any superior mortgages already secured by the property. Under a wrap, a seller accepts a secured promissory note from the buyer for the amount due on the underlying mortgage plus an amount up to the remaining purchase money balance. And since the payments on the new mortgage are larger than the old mortgage, the seller keeps the difference as positive cash flow. Now, this is the basic definition as a wrap, but I also want you to look at it as an additional loan wrapped into one loan with the seller. You can work just about any kind of property, but my personal favorite is single-family homes. As with the query I did, where I targeted above $300,000, you can really do this with any price point. I just like working with absentee owners where the property is above medium price point range because generally these properties are not distressed and in good condition. Also want to market sellers that have owned the property for more than 2 years. Could be a tired landlord, maybe someone that has moved far away and they don't want to worry about it anymore, or someone that can't afford making the payments because they're making payments on the home that they live in as well as this one. And there are many other reasons. Also keep in mind that I put an equity amount of 20%. This will open up more properties than if I targeted properties that just have a lot of equity. And when you work with someone that has little equity, they're more likely to work with you because they may not be able to sell it, especially if they have to pay real estate commissions. At the end of the day, we just want to market a targeted list so you're not wasting money on direct mail or skip tracing. So let's look at an example so you can see how the numbers break down. And in this example, it doesn't matter if you're the buyer or seller. I just want you to see how these numbers break down. So here we have the original loan amount for the seller. And now when we're going to create a wraparound, it literally wraps around the existing loan. So let's look at an example where I can show you how these numbers break down. So here we have the seller's loan balance at $300,000. Now keep in mind, we will be running comps. We're doing property inspections. We're doing all the basic necessary things in order to come up with a valuation. All we're saying here is this is just the balance of the loan. Their interest rate currently is 3.5%, which gives a monthly payment of $1347.13. And they have 20 years left on the loan. Now we're going to create a new wraparound mortgage where a buyer, which could be you as the investor coming into the deal, or you could be the seller doing this, it can work both ways. So we set the sales price at $350. Now keep in mind, obviously, like I said before, we're going to be running comps to verify, what this property is worth. I just want to keep this example simple so we can just grasp the concept. Now, of course, the seller's going to want a down payment. So in this example, we put $10,000 down. Now, of course, could you get in with no money down? Sure. But most cases, you're going to need to put something down. We set an interest rate at 5%, which gives us a monthly payment of $1878.88. We're going to amortize this loan over 30 years to get that $1878, but we're going to set a term or what we call balloon payment for 10 years. So we're going to pay the seller $1878.88 up to 10 years. And then whatever the balance owed is, we're going to cash them out. Now, you don't have to wait 10 years. You could do it tomorrow, but you have all the way up to 10 years. One thing you'll notice is the taxes and insurance. So whatever the seller's paying in taxes and insurance, that same dollar amount is pretty much going to be the same for you. So I'm leaving it out of this example because it would be a wash. So let's look at how the seller actually profited, no matter if it's you being the seller or a seller profiting with you coming in as the buyer. So the first profit center is the down payment. So they're going to make 10 grand the day you close on this deal. They're going to have a monthly cash flow, in this example, $531.75. Remember, times 120 months, and that's assuming the buyer went the full 10 years. That's $63,810 in cash flow. Now, the loan balance for the seller, and again, we have to amortize this using a mortgage calculator. If you're an REI Pro member, you can go into your business center as well as step 4 in any property to calculate this. So what I did is I took the balance owed from the sellers first, and then our wraparound portion, I balanced that out as well. And that difference is going to be $52,415.31. So that gives a total profit of $126,000. Now, keep in mind, this was over a course of time. Now, if you're the seller, I want you to look at, so this $40,000, remember, we're buying it for $350 minus 10 grand, that leaves $340, and the owner has a first mortgage for $300. So that $40,000, they're making the full 5% interest on, where the $300,000 that they're still paying on, they're only making 1.5%, because remember, they're paying 3.5%. We're paying them 5%, which leaves that 1.5% on the remaining. Keep in mind, there's no maintenance repair costs. You just imagine calculating that up over 10 years. And what about turnover costs? You're not going to have any turnover costs because the buyer's just making those payments to you on time every month for up to 10 years. And no management fees, because you don't need somebody to oversee this. You have a buyer in the property where you have deeded them the house, so they own the property, and then you're carrying this additional note on top of paying your first note. Now, there are several ways on how this money can be handled on a month-to-month basis. I would just recommend having an escrow company coordinate the payment. So number one, we want to make sure that the bank is getting paid. You don't want to just, send the seller the payment, although you could, but, there's some risk involved when you just pay the seller and hope that the seller's making the payment. So using an escrow company would definitely speed this process up. It's going to be more secure, and I think everybody at the end of the day is going to be happy. Now, when would you actually use a wrap? You need seller financing to buy properties because maybe you don't have a lot of cash to put down. Maybe your credit's not perfect. Don't want it on your credit report. Anytime there's an existing mortgage, that's what we're doing. We're wrapping an existing mortgage. If there wasn't an existing mortgage, we would not be doing a wrap. Attorneys are more likely to do a wrap than a sub 2. And what I mean is that a subject to protects the buyer, not the seller. So if you had a seller that wanted to maybe purchase another property, they would be able to show income coming in using the wrap. Now, with that being said, there are several reasons why you wouldn't want to do a wrap. And one big reason, what happens if the seller dies? In this case, you would want to create a new mortgage with a subject to, not a wrap. Because if you're buying the property subject to, the seller is out of the picture, and therefore you won't need the seller to sign off on anything down the road. Another point I want to make is that you're going to need to find an attorney that understands these creative financing strategies and how to draw up the paperwork. Most closings in the US are not done this way. Doesn't make it illegal. It's just not common. But all you need is one attorney that understands how to do it. You can always check your local REIA clubs to find these people. As you can see, this is a creative way to purchase and sell properties without going to the bank. But you're going to need to cross your T's and dot your I's and get as much education on the subject as possible. I don't want to see you make a mistake that could put you in a bad situation. I'm not trying to scare you. I'm just giving you some facts. And that's a wrap. No pun intended. I put together a video that will teach you how to seller finance real estate, where I could go into more depth into this strategy. You should go and watch it now, and I hope you got some value out of this training. If so, please give that thumbs up. It really helps me out, and I'll see you on the next training video.